Thank you very much. And with that, could we have our legal uh, spiel?
Yes, sir. For the record, I want to note that this is the regular investment committee meeting of the Kentucky Retirement Systems. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute, Section 61.826, and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. I ask if you are speaking and not appearing by video, please identify yourself before talking. In the event this meeting becomes disconnected from Facebook, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. And Sherry, could you do the roll call for us?
Yes, sir. Mr. Lane,
Here.
Mr. Atkins, Miss Bova,
Here.
and Miss Thompson.
Here, excuse me.
Thank you.
And it seems we do have a quorum, but don't see any voting issues we have to have other than the approval of the minutes. We have no public comment, I understand, and so we'll go on to the approval of the minutes of the February and April meetings. Everyone
Mr.
should.
Chair, Mr. Chair, if you
Yes.
will give me just a moment, Mr. Atkins is coming on, and I can adjust
Will-
the attendance to show.
We'll certainly wait for him.
Here.
Oh, there you are. Thank you. I will mark him as being present. Thank you.
Good morning. Okay, let's move back to the approval of the minutes of the February 19th meeting and the second minutes that we have. Everyone should have received these. Any comments or changes that you'd like to see?
I was not in the meeting, but it looks like Pruitt, your name is listed backwards. Lane Pruitt instead
Well.
of Pruitt Lane.
Well, you know,
We will change that.
I didn't notice that, but people have called me all sorts of versions of my name. But thank you. And so could we have a motion to approve these 2 minutes, board minutes?
I'll make a motion to approve both minutes.
Thank you. Second, please.
Second.
Thank you. And if there's no objection, we will consider those approved. I don't believe we need a roll call vote on that. So the minutes are approved as submitted. And let's see, could we get back to I'm working off of my phone, so I'm a little bit, our agenda. Steve is not with us this morning, so I believe Anthony and Joe are going to cover the investment review and update.
Yeah, we're here. Thanks, Pruitt. Yeah, we'll start with, can we go to page 14, please? Sherry, thanks. Sure. We won't be long on this. I mean, things can change a lot since this is the first quarter, or not a lot, depending on how you look at things. The first quarter was a pretty benign quarter in terms of, U.S. stocks and rates drifted down a little bit. I guess people were waiting to see what would happen on Liberation Day, and things happened. Both really went down after. I think we bought them at around 386 on the 10-year, 4,800-ish on the S&P. And then, today we're basically back where we started the year. So 460 on the 10-year, 5,800. So you just, went away and didn't pay attention. You knew nothing would happen, but obviously a lot did. I guess the other thing to call out is, gold had a pretty big run. And we're all, I think what CNBC and all are calling Sell America's, somewhat been expressed that way. But it hasn't obviously changed the overall allocation or anything a ton. If you go to the next page 15, you can see the asset class assumptions for Wilshire. Again, not huge changes. A couple of things of note are just I think Wilshire still sees private credit as higher returns than PE over the next 10 years, with high yield maybe not far behind. I think that does directionally square with our team's belief that we don't have to go that far out the risk return curve to meet our goals, which for the KNS plans are between 5.25 and 6.5. So I think that's part of the positioning we've had and continue to maintain. So if you go to page 38, please. This is the performance for the quarter, fiscal year to date and onwards. I think if you look at fiscal year and beyond, pretty much everything's in line with benchmarks or better. I think the notable exception is still private equity, which we've discussed a lot. There's a lot of timing there, since especially when we've had 2 consecutive 20% plus return years for stocks, especially which we're being measured on the Russell 3000 plus 3% right now. We've been underweight there in real estate, which overall have been helpful to the portfolio. Public equity and fixed income, you can see, have kept pace or outpaced their benchmarks. I'll turn it over to Joe and Brian in a little bit to give some detail. And then I'll have a few words about private markets after that. But first, though, can we go to page 40, please? All right, this page is about internal portfolio performance. So some of the things we manage internally. We've been underweight in private markets, and so we've utilized some proxy exposure to get to be at target weight while we wait for some of our managers to call capital, or wait for us to find some other attractive private opportunities that we think will be worth both the work and all the fees. So you can see that has been pretty good, along with the strong equity market. They're going to be tied to that, of course, since it's listed. But our proxies for real estate, real return, those have done well and kept the KNS plans at target, basically. So we can go to page 41, please. This page, I think, is new for the KNS plans. This is BNY is now able to break down asset class performance for each plan. It's on a gross basis only right now. It's not super different for the plans, but it can vary depending on the weights historically, especially for KNS pensions. As you guys know, that they didn't do private equity for about 10 plus years. So that, has that, the weight was a little down and the returns were less as a result. So that's basically what this is. This is just a new cut at the data that BNY has able to provide now. But now I can turn over to Joe and Brian to have some color on their markets. So I think Joe, public equity, I think it's first, if you want to.
Okay. If you'll go to, I guess I'm going to be speaking to pages 45 through 48. And really what we saw was, if you recall, the end of 2024, we had the election, and there was some excitement as far as potential tax policy changes and some deregulation. And so that really got the markets moving upward. That continued that momentum into the first quarter. And then essentially the bottom kind of fell out there towards mid to late February, where tariff discussions started occurring, and there was some concerns as far as their implications on future economic growth and what that might mean for inflation. So pretty much all the U.S. Indices, you saw them really retrace. There was a repricing of risk, a little bit of a flight to quality. And so what you saw was market leadership in terms of market cap remained stable as far as large caps continue to dominate their smaller cap counterparts. It's been that case for a while. However, you did see a style shift in that value all of a sudden outperformed growth, which was kind of the first time we've seen that for a while. And not only did it outperform significantly, this is kind of attributed to that comment where I made a little bit of a flight to quality. So quality, as defined by kind of return on equity or dividend yield, performed well. Low volatility names did much better than their high beta counterparts. So things, if you think about the Mag 7 and how that kind of dominated most of 2024, those really got hit hard towards the end of the quarter, in that their valuations essentially were pretty stretched. And so any sign of weakness was going to hit them harder than maybe the rest of the market. And so we saw that occur. At the same time, international markets actually, while still facing some of those tariff concerns, did fairly well. They actually outperformed. They did so on the backs of a lot of the NATO countries and some of their comments about defense spending and what that might mean for some of those industries, as well as Germany passed the stimulus package aimed at infrastructure. So that helped their domestic market. China and the emerging markets actually performed fairly well because of growth kind of started to accelerate a little bit in Q1, and that was kind of on the backs of some stimulus that occurred in late 2024. Active management struggled a little bit in the international space in that quality, while there was a flight to quality on the U.S. side, those names that were viewed as less a lower quality as defined by return on equity actually performed better in the non-U.S. markets. And so the last couple of quarters have been really difficult for those names that were viewed as more quality companies. And so active managers who tend to flock to those type of companies have struggled a little bit. In the international markets, valuations have remained stretched and those growth-oriented names above their typical premium fairly significantly. Value names have been trading at lower than their typical discount. And so there's some potential areas for exploitation for some active management there. Outside of that, the quarter itself, we were down about 1.3%. I'm on page 47 at the moment. This was about 30 basis points of downside protection. This really had to do with our tilt towards non-U.S. equity. While the bulk of our assets, as far as public equities, are in the U.S., we do have less U.S. exposure than the benchmark does. And so with the non-U.S. outperforming the U.S. by over 9% during the quarter, that was a benefit towards us. Within the U.S. Mandates themselves, we actually had really good performance from stock selection. 6 of the 7 strategies outperformed during the quarter. And the non-U.S. space, it was more split, kind of 50-50 as far as relative outperformance. However, unfortunately, the left-wing negative tails were a little bit larger to a degree than the positive tails. So while we had a 4.4% return, we did trail the index by about 20 basis points in those spaces during the quarter. And then over on 48, kind of give some commentary on the 12-month period ending 331. We were, as a global equity, down about 120 basis points. This has to do with our underweight to U.S. equities. That was a bit of a headwind for us. I will say April was a continuation of that weakness felt in March for the bulk of April. We actually performed well from a relative perspective. Now, there was a bit of a bounce back at the last part of April and into May as there was some talk about relieving, at least pausing some of those tariffs. So the U.S. markets kind of rallied back a little bit towards the end of that, and growth had a pretty good little bounce back. But if you were to roll this 12-month cut of March 31 to April 30th, these are preliminary, but our one-year performance now sits at just about 17 basis points behind. So we've had a nice bounce back. If we were to show it just a 1 month different timestamp on this, our 3, 5, and beyond are all positive net of fees. So the portfolio in general is performing pretty well given a very volatile market at the moment. That's really all I had prepared. I'm happy to take any questions, or we can roll on to Brian for his credit comments. So.
Thanks, Joe.
Okay.
I'll start on page 49. And the Federal Reserve Board was on hold during the quarter, keeping rates unchanged. However, they did downgrade the outlook for growth and increase their inflation projection. Yields finished lower, starting at the 2-year, going out to the 30-year as the curve bull steepens, with the closely watched 2 to 10 curve remaining positive at 32 basis points. Page 50. Core fixed income returned 272 basis points for the quarter and 483 basis points fiscal year to date, underperforming the benchmark 6 basis points during the quarter, but outperforming by 2 basis points fiscal year to date. Corporate bonds were the worst performing spread sector, trailing similar duration treasuries by 85 basis points for the quarter, with half of that being in March alone. The credit curve steepened as intermediate and long spreads widened 10 and 17 basis points respectively. April core fixed income return is not final, but early numbers have it up 41 basis points, and 3 weeks into May, the month-to-date return is down 1.3%. Page 51, liquidity. For the quarter, cash returned 108 basis points and 365 basis points fiscal year to date. At the end of March, The market was pricing 3 rate cuts in 2025. As of this morning, the market is now pricing 2 cuts in 2025, matching the Fed's guidance. The consumer one-year inflation expectations jumped to the highest level since 1981 due to tariff uncertainty. However, Chair Powell labeled inflation from tariffs to be transitionary. Page 52, specialty credit. Specialty credit portfolio returned just over 2% for the quarter and a little over 7.5% fiscal year to date, outperforming the custom benchmark by 128 basis points and 182 basis points, respectively. Softening economic data and forward earnings guidance, along with increasing trade policy uncertainty, resulted in modest, wider public high yield spreads, while total returns remained positive. The risk-off tone resulted in decompression, with lower quality issues underperforming, with B and CCC returning 74 basis points and negative 43 basis points, respectively. And in a reversal of a 3-year trend, fallen angels outpaced rising stars over the quarter, with the largest fallen angel volume since the second quarter of 2020. That's the last page for me. I'm happy to take any questions.
Brian, do you want to give a little explanation of the fallen stars and the rising stars and the fallen angels?
Sure. The 3 major credit rating agencies will change the credit ratings on particular corporations, and the falling stars is when it falls out of investment grade, which is basically BBB plus or better, and then the falling angels would be investment grade corporates falling down into the high yield bucket.
Yeah, I bet. How many do you may have seen this? How many upgrades were there so far this year?
I actually don't have that number offhand, but I can get that for you.
No, it's it just occurred to me. The upgrades tend to be very few,
Yes.
and of course the fallen angel right now of discussion is our favorite country, which Moody's added to the piling on to downgrade it to AA plus, where S&P and had previously done that a long time ago. So
Yeah, Moody's was last to the game on that. S&P did that in 2011, I
11.
believe, and then Fitch did it in 2023. So Moody's was the last of the big 3 to do that.
Yeah, our president didn't have very nice things to say about Moody's, but and the point is that the market we're still considered the premier credit in the national debts of most countries compared to most countries. So no big impact, and but it did stir a lot of discussion on the business channels and the like.
A lot of headlines.
A lot of headlines, yeah. Okay, Anthony, do you have you want
Sure, yeah.
to come back?
Thanks. Yeah, sure. Can we go to page 54, please? All right, for the real estate part, about 2/3 of our exposure is open-end core funds, and those have had about 7 quarters declines until recently. And those have started to turn the corner, and we've started to have positive appreciation again. And so 2 of our 3 funds have met their redemption queues, unlike some of the other open-ended funds, and they've actually started to call capital down to make acquisitions. The third one also did a lot of selling in the fourth quarter of non-core assets, and so they've been putting a lot of that towards paying down their redemptions as well. And that particular manager is well positioned. It's in a lot of the attractive asset classes that are deemed alternative right now, but they're becoming less alternative. I think the index is starting to include more of the self-storage, medical office, senior living, those kind of properties, which I think have a lot of tailwinds and are of interest. So we have a decent amount of exposure to that. And so going forward, though, real estate, I mean, it's still not huge projected returns. There was another consultant's webinar this week that projects about 5.5% for core funds. I think that's not far from Wilshire's 5.7 to 6.5. That was on that previous assumptions page. And that 6.5, I think, is a high end, which includes closed-end funds, value add strategies, things that are further out the risk curve. But there is steady income to be had there. So I think our open-end funds are about 3 to 4%. I mean, it's still not beating cash right now, but there is some appreciation potential for the assets as well as the rents to keep up with inflation and also diversify our portfolio. So there's reasons to have it, but it isn't. It is still surprising me that's a little bit lower than private equity in terms of the same amount of lockup and leverage. But that's that. To the next page, we can go for real return. For here, this is where we spent a lot of time in past few years, trying to find ways to get contracted cash flow streams that aren't as closely tied with the market. A lot of times because those assets are scarce or essential. So that's your midstream energy, energy production, farmland, transportation, leasing, sports. So those are some of the things that we've done in this area. Ultimately, MLPs have driven the bus for midstream energy the past 5 years, and they continue to do so. This is off of a crash, of course, 5 years ago during March of 2020. And COVID, it's annualized almost 40% since then off those lows. So that's why those numbers are very it looks so outsized compared to everyone else. It also fell a lot first. The other thing on the right side is data centers. I'm sure it keeps coming up, at least for us. Maybe you guys see it in the news too. Just the demand for power and and the other resources required for those are discussed a lot and also impact the space, particularly because there's a lot of deals in electric generation and just energy in general to meet that. And so it is an area of interest, and we have had managers working in that space as well. I think a couple of them have done power plant deals. Obviously, the midstream is getting buoyed by that, and also even some of the other real assets that need land and other resources to do that. Those are also potentially seeing benefits. So it's an interesting area. And then, all right, next we can go to the next page after that. So private equity, again, it's still mostly the same, so I don't have to probably spend too much time on it. Transactions are still relatively slow. We have seen a few exits, but not many. There's still a decent bid-ask spread, and there's a lot of dry powder out there. So it's definitely impacting fundraising. We've seen some funds that are closing well below target, just because either our peers or other people can't allocate to them because they aren't getting enough money back. We have been relatively light in this area because it's just the risk return of locking up for these is not as attractive when interest rates are much higher, because there is some reliance on that to make these deals work. So, and the math is a lot harder when interest rates are where they are versus when they're almost zero. So, but yeah, so that's about what we have for there. And then onwards, I think we can go to page. Let's see here. Can we go to page 70, please? So this is the usual Wilshire peer group charts. So you can see it's been, again, like usual, very good risk reward. So we've been getting top decile returns for the risks that we're taking, and the returns have been good. They're top quartile for 1 and 3 years, near the bottom for 5 years, because that includes a very strong equity performance. So as you can see, when the equity is really strong, we tend to underperform, and when it's less good, we tend to do better. So that's given the lower amount exposure that we have, given our risk profile, KNS with underfunding, and also the targets that we're going for. So, can we go to 76, please? All right, this is another peer analysis, like basically a similar way of showing it. Again, very good risk reward and good returns for the past few years when market, which includes the 2022 years that was down. So, and then can we go to page 82, please? All right, this is asset allocation. Like we were talking about earlier with the proxies, that is what has helped us get a lot closer to the targets. As you can see, the blue triangles are pretty close to the black lines in a lot of cases. Um, so that's that's a lot of congratulate or a lot of work done by Steve and Brian especially to help get us towards that. So, but yeah, I think that's about it for what we have investment wise. We're happy to take any questions if you guys have any overall about this or the portfolio or anything.
Sorry, I was just gonna add
Oh, sure, good.
to your comment about being,
Mhm.
for the most part, being pretty close to the target.
Mhm.
Everything's within allowable ranges at this point. So
Oh yeah.
there
Mhm.
any compliance issues from that perspective. So
Yep.
Yeah,
Thanks,
you,
Jeff.
if
Yeah.
you will, but the committee will remember that we went for a while with being out of the asset mix range for a couple of categories, particularly total return and the like. And we probably didn't manage that change of the policy very well. And so going forward, when we change the policy, there will be a phase in of getting into the compliance, because it's awfully hard in those relatively thin asset classes to
Mhm.
make an immediate jump of even 2 or 3% in our asset allocation. So, but I think we've got it going on the right track now, and the board would be very involved. The investment committee, at least, would be very involved in how we adjust to any future changes in our asset ranges.
Mhm. Yeah, exactly. There were some pretty big changes, and so yeah, it's hard to move some of the things in private markets that quickly. But that's why I think the proxy solution has been a good one. It's helped to at least keep some exposure that's related, even if it's not exactly what we're going for. But it's been helpful to get us towards that. So thanks for everybody helping on that.
Yeah. Um, any comments or questions from from the committee members? Okay, then we will move on. Um, let's see, our next item on the agenda is, I believe, let me get my bigger print here. I don't have my glasses on.
That's okay. It's the investment budget update.
Investment budget update.
Yep. So that's page 119. Sherry, please. Through first 9 months of the year, the expenses are in line. It's about $9 million almost, or around 70% of the budget is spent year to date. So that's pretty much in line. There's a couple outliers, the Mercer and the new private market consultant line items. Mercer is just kind of a timing issue. It just has 2 quarters instead of 3. So that's just a little timing thing. There was intention to do an RFP for private markets during fiscal 25. That's been delayed, and we're looking at completing or onboarding that in the next fiscal year. And then the other thing to call out is kind of legal and auditing. There's just difficulty to budgeting that sometimes because realized expenses are based on litigation, which is not the timing of that's not totally in our control, obviously. And then there's been some variance on the individual line item level. Again, that's with litigation, but I think Michael Board and his team has done a really good job forecasting and budgeting. This fiscal year has been a big litigation year, and fortunately, it was not larger since there was some settling. But still, we still expect some litigation activity and expenses going forward. But with some things getting resolved, I think there's going to be a reduction planned for fiscal 2026. So that's what's involved here. And then can we go to page 122, please? All right. So for the pension level, the expenses fees and expenses are a little bit higher than the same period last year. About 23% higher, while assets are up 8%. Some of the main increases are, there's 3 million in administrative expenses, and then a lot of the other ones, especially in private markets, it's about 5.5 for real return, 7.5 for real estate, almost 4 for credit. A lot of that's basically increase in assets and then some reversals of the performance fees. So those are accruals based on markups or performance. So that's a lot of change since that was not the case the prior year. Public equity class, it's a little off maybe with the larger fee and asset size, but that's kind of timing. And so ultimately, we're also getting some benefit from lower fees in core fixed income because I think Steve and Brian have been managing a decent part of the portfolio more internally. So fees have gone down 12% year over year, even though assets are up 33%. And then there's been 3,000 a large reduction in management fees from 2021, even though assets have gone up by over $1 billion. So it's a big ups to them for large fee reductions there. Page 124 and 125, please. This shows how they're broken out by the pension and insurance portfolios by asset class. So again, like you were saying, the big swings are usually going to be performance fees, just depending on how things are marked and are going. That those can really swing a lot. But happy to take any other questions you guys might have.
On that first page that we looked at, what is, I don't recall prior to that one. The
so
it's
119
like
maybe?
IMS. Yeah, what's Intelligent Management Solutions?
Center legal and auditing. We can get back to you on that one. I'm not really sure exactly what that is, but we can ask legal and not for you.
Okay, thank you.
Unless Vicky or somebody else knows, I don't know what that is.
Ms. Bova, everything in that section are legal contracts. So it could be e-discovery, could be an actual legal contract, but everything there is about one piece of litigation or another.
Okay, interesting. It just surprised me up, 240%. It's way off budget, but I don't even know what it's for. So
Yeah, we'll get back to you. I'll get Michael Board and to give us an answer on what's I was familiar, I thought, with IMS, but I think it may be an expert. They were. I won't speculate, but we'll get that for you.
Mhm.
Any other questions for Anthony on the budget? I do want to remind people that when our fees go up because the performance fees are up, that's a good thing.
Mhm.
We don't mind paying more money if we're making more money.
Mhm.
But
Oh, sorry, I just looked at the notes for page 121. It says IMS was an expert witness for Bay Hills, so that's what was involved for that.
that's what I thought it was. Yeah.
Mhm.
But so okay, I believe we're finished here. Any other questions on the budget? And if none, we'll move to Carrie Bass.
Good morning. I am here for a short and sweet quarterly investment compliance report. I'll take the next page, Sherry. And one more page after that. Thank you for zooming out. During the quarter ending March 31st, 2025, all of the guidelines in your policies were in compliance. There are no exceptions to report. Next slide, Sherry. So you can just see those guidelines and each has a compliance marking. And then Sherry, we can move ahead to no exceptions. And as you've already heard, next slide, Sherry, all of your asset allocations were in range during the quarter ending March 31st, 2025. And last but not least, for the quarterly compliance report, I've included the the proxy voting report for the quarter ending March 31st, 2025 for compliance with KRS 61650. And that has been posted. The quarterly proxy report has been posted to the website in compliance with 61645. So we are in compliance on the proxy reporting. And then my last slide is just to touch base on a conversation we had during the last investment committee meeting about the independence of the compliance officer position. And just to follow up on that conversation, The data that I rely on to compile the quarterly compliance reports is largely obtained from a neutral third-party source. Everything I do is of course subject to internal and external audits. So that's an additional independence factor. And I understand that it is my duty to have a direct line to report to this committee. And hopefully we'll be able to codify that in future investment policy statement updates to make that clear that I have a reporting obligation to this committee in the event that there are any significant compliance issues. And then finally, while the bill to create a separate office for finance that I would be attached to was not successful, did not go through the complete legislative process this last session of the General Assembly, the KPPA continues to work on the goal of moving my compliance officer position outside of investment to ensure that independence. Any questions? Okay, well, thank you so much for your time.
And thank you for your report. It is thorough and it's good news. So we went on both matters there. So I don't see anything else on our agenda. So unless someone has any other comments that they'd like to make, and if not, then I will consider this meeting adjourned.